All right, we're going to dive in to the next module, which is really the foundational knowledge. What are the basic building blocks or the periodic elements of venture finance? And before I get into that, let's talk a little bit about choice of entity, because that's a strategic decision for businesses. A lot of businesses are organized in a pass-through form. Like in the US, it's called an LLC, limited liability company. And that's great. There's all sorts of tax reasons why people do that. Another form of organization is the corporate form. And this particular module and the Venture Finance 101 is really focused more on the corporate form, because that's the corporate form that is the preferred choice for venture capital firms. Now, there's lots of other ways to finance your business through other forms, but those building blocks are different. So for purposes of this, we're going to assume that you are, in fact, organized as a corporation. If you're not, then we'd have to tweak some of this, and we'll get into why there's a lot of tweaking in venture finance. But the basic building blocks of a corporation are really common stock. In the US, that's what it's called, or common shares. Over in Europe, they're called ordinary shares or voting shares. That's the most basic common building block. That's an equity security. So it's issued to the founders at inception. The next form that you see a lot in venture finance is something called a convertible note, or a convertible debt instrument. And that has, it can be, in fact, debt, as it sounds, but it's converted, and it's an interesting instrument in the sense that you can avoid difficult valuation sorts of issues. So it's a way to bring in some capital on a easy, less expensive to structure and more flexible basis. That is then later converted once the capital structure gets a little bit more defined. And then the third form is preferred stock. And as the name would suggest, it's different than common stock or ordinary shares because it has a preference. Now, the preference can in some cases be better or worse, so it's not necessarily better, but it's a convenient way to bring in capital where people that contribute cash have a slightly different preference to those who contribute sweat equity. So those are the basic building blocks. One of the first issues and considerations for any entrepreneur is what's the choice of jurisdiction where you want to organize, and what's the type of entity that you want to organize. And that's an important decision. And so for purposes of this whole course, I've made basically an assumption that if you're serious about trying to raise venture finance from third parties, that the choice that you made was that you picked a corporate form. A lot of businesses, in fact, a strong majority of businesses, both in the United States and outside the United States, actually make a different decision to use some kind of an LLC or a pass-through entity structure, and there's very good reasons for doing that. But for purposes of, at least in the United States, and I would say my experience outside the United States, if you're serious about trying to access large amounts of third-party capital from angel investors or VCs especially, the corporate form is the preferred form. And a lot of the discussions that we're going to be going through in terms of the building blocks and the financing arrangements are going to be based on the assumption that you did make that choice to go with the corporate form. All of this stuff is really something you have to consider with your tax, legal, and financial advisors because it's constantly changing. So one of the things that I've experienced is that sometimes people will organize their corporation in a pass-through form, like an LLC. And that works fine because it's more tax efficient. And then at a later date, they change their mind and say, oh, actually, I do need third-party capital. that can be kind of expensive. There's all sorts of tax and legal issues. And if you do need to convert, which you can do at a later date, you just need to be mindful that that's going to require some professional assistance from lawyers who are skilled in the art and accountants. And just be aware of that. It's an important consideration. Before we get into the building blocks and the rest of the material, I do also want to address another issue, which is when you're building your management team, you're looking to attract the best and brightest people with relevant experience. Likewise, when you're building your outside professional advisors, your lawyers and accountants, it's important to make sure that you have somebody who understands this. Now, for venture finance, if you're trying to find a lawyer in their local market, it pays to make sure you do your research. If you were to go to a lawyer website and they say, we do startup financing, we do venture capital, venture debt, corporate finance, and securities, that's what we're talking about. That's this expertise. And why is it important? Well, because if you think about venture finance, it's very specialized. And the people who do it all day, every day, not only do they have the knowledge and the forms and the templates, they also have the connections. So these people not only can advise you, they can also help connect you. Now, every city and every country has a different community of these people. So the choice of entity and the choice of jurisdiction is an important one, because if it turns out you decide you want to organize in Liechtenstein, then you're talking about Liechtenstein Legal Counsel. And if you decide, no, I actually want to be in Ireland, or I want to be in, say, the USA or Singapore, well, then you got to find that legal counsel in Singapore. So that fundamental decision of choice of jurisdiction then leads to the secondary question is, how can I hire the right professional advisors in that jurisdiction?